Tesla stock is currently trading at $389.77 as of 5:05 a.m. EDT on Wednesday, April 22, 2026. This represents a decline of 0.70% in early intraday movement, continuing a cautious trend as the market braces for the first quarter earnings results scheduled for release after today's closing bell. Its AI-5 self-driving chip. This is not just a technical footnote, it is the physical foundation for the Optimus robot and the massive supercomputer clusters the company is building. When a design is taped out, it means the final blueprints have been sent to the foundry for manufacturing. We are seeing Tesla transition from software-based autonomy to building its own specialized silicon at a scale that very few companies on Earth can match. This is the curiosity loop that's keeping the big players on the edge of their seats. Is Tesla spending $20 billion this year to sell more Model Ys, or are they building the world's most advanced physical AI infrastructure? The common narrative you will hear on traditional investing sites is that Tesla is overvalued compared to Ford or Toyota. Critics point to the PE ratio, which currently sits at a staggering 359, and argue that the math does not add up for a company that delivered 358,023 vehicles this quarter, a figure that actually missed Wall Street estimates. However, the contrarian take that is actually driving the volume today is the terafab. Tesla is planning a 1 terawatt AI compute facility, and the capital expenditure for this project is not even fully baked into the current guidance. If you are using platforms like Fidelity or Schwab Intelligent Portfolios, you might see these high-level analyst ratings that look at auto gross margins, but they are often missing the forest for the trees. The forest here is the shift toward the Cybercab and the Robotaxi network that is already live in cities like Austin and San Francisco. Recent trading volume has been intense, with a 44% surge in activity compared to the daily average. This kind of institutional movement suggests that the smart money is not just sitting on their hands. We saw 70% buy orders in the final hour of trading earlier this week following the AI chip news, but that has been met with tactical selling as we approach the earnings sprint. It is a classic high beta setup. When you look at the Tesla stock chart on a Robinhood app or through an interactive broker's platform, you can see the stock has broken out of a descending channel that held it down for most of early 2026. Technically, it is testing psychological resistance levels near $400. Whether it holds those levels depends entirely on how Elon Musk justifies the massive $20 billion spend during today's call. There is a significant gap between what investors expect and what the balance sheet is revealing. For instance, production reached over 408,000 units this quarter, but deliveries were only about 358,000. That leaves 50,000 cars sitting in inventory. In the world of traditional online investing, high inventory is a red flag. It suggests demand is softening. But for those doing self-investing and digging into the robotics side, that inventory might just be the necessary buffer as Tesla pivots production lines toward the long-wheeled-based Model Y for the Indian market or the upcoming 6-seat configurations. Institutional activity through Fidelity Investments and Fidelity brokerage accounts shows a divide. Some desks are focused on the capex creep, fearing that the massive investment in AI will lead to negative free cash flow this year. Others, like the bulls at Wedbush, are looking at a $600 price target, betting that the autonomous ride-sharing network is the biggest growth chapter in the company's history. If you use a SoFi robo-advisor or a SoFi trading platform, you might see a more balanced or hold sentiment, which reflects the broader market's uncertainty. We are at a point where the stock is effectively two different companies, an electric vehicle maker with 18% gross margins and an AI startup with infinite potential and massive costs. Comment below how many shares of Tesla stock you currently hold, or if you are waiting for the earnings dip to buy more. It is always interesting to see how the community is positioned before these massive volatility events. To understand where we are, we have to look at the business model. Tesla operates a vertically integrated system that spans from battery chemistry to the proprietary FSD software. Unlike rivals who buy off-the-shelf components, Tesla builds its own chips, like the AI4 currently in vehicles and the upcoming AI5. They also operate their own charging network and insurance arms. This ecosystem is what allows them to maintain an operating margin of around 5% even during volume soft quarters, whereas many legacy manufacturers struggle to even turn a profit on their EV segments. Earlier reports showed that the transition to the 4680 battery cells was a major hurdle, but those production bottlenecks are largely in the rearview mirror. The focus has moved entirely to physical AI. As we look toward the future, the expectations versus reality framing becomes even more critical. The market expects a slow, cautious rollout of the Robotaxi service into 7 new metro areas. If Tesla announces that the Cybercab production is ahead of schedule or that the terafab infrastructure is coming online faster than anticipated, we could see a massive re-rating of the stock. On the flip side, the reality of regulatory setbacks or safety incidents in the autonomous testing phase remains the biggest downside risk. Institutional investors using interactive brokers or Fidelity Wealth Management are watching the smart estimate for today's earnings, which is actually lower than the consensus. This suggests a potential whisper miss on earnings per share. If the reality of the earnings is a miss, but the reality of the AI progress is a beat, the stock will likely experience a sell the news, buy the future reaction. This is the tension that keeps the Tesla stock price so volatile. You have people trading it on the Robinhood app for quick gains based on headlines, while long-term holders through Fidelity IRAs or SoFi Investing are looking at the 2030 horizon, where Optimus robots could theoretically be a larger business than cars.
The macroeconomic environment is also playing a role. With the S&P 500 recently hitting record highs and the Nasdaq hovering near its peak, there is a lot of liquidity in the system looking for high-growth homes. If you are into online investing or use an intelligent portfolio, you know that Tesla's movement often dictates the sentiment for the entire EV and AI sector. When Tesla moves 4% in a day, it drags the ETFs and mutual funds with it. To summarize the situation, the expectations for today are centered on a soft earnings report characterized by inventory builds and margin pressure. However, the reality of Tesla's technical milestones, specifically the AI5 tapeout and the Terafab expansion, suggests the company is accelerating its move away from being just a car company. The contrast between the boring reality of selling cars in a competitive market and the exciting reality of building a global autonomous network is what creates the trading opportunities we see today. We started the day at $389.77 with a slight downward bias, but the real story will be written after the bell. The authority in this space belongs to those who can see past the quarterly delivery numbers and understand the massive capital deployment toward physical AI. Tesla remains a high-stakes bet on the future of autonomy, and whether you are using a Fidelity mobile app or an Interactive Brokers account, the key is to watch the capex guidance. If they are spending more, it means they are seeing a path to a much larger reality than the market currently expects. Stay grounded in the data, watch the volumes, and remember that in the world of Tesla, the narrative often moves faster than the vehicles themselves. It is a landscape defined by massive ambition and equally massive costs. And today's performance is just one small chapter in that much larger story.